Welcome again to the Rick Helps Real Estate Show. If it's your first time, we go over this crazy Arizona real estate market. Today, I'm continuing my traveling road show edition. I'm still traveling in the Pacific Northwest, actually not doing a lot of traveling, kind of staying in one spot for about another week. Then I'm going to be zipping around all over the place. And good morning to you, Betta. And I will be heading back to Arizona on the day after Labor Day, taking my time. Probably take about 7, 8 days to get there. So I'm just going to take it easy. No sense of being in a hurry to get back to the heat, right? But I will be back there, and we're already talking about having another meet and greet. So with the whole gang, we don't know where yet. We're working through the details, starting to early discussion stages. But when I get back to town, hey, let's party. So, and good morning, Danila. So today I wanted to talk about, because I saw a few videos this weekend, like I do, every week, crash, crash, crash. And I just find myself looking at the people that are presenting and continually saying, but why? In other words, inventory is going to go way up and we're going to have all these houses. Like, okay, but why? And I want to encourage those of you to ask that question whenever you see anything on here, including me. Say, but that's going to happen. Okay, but why? There has to be something that makes inventory go up. There has to be something that makes prices go down. You can't just say prices are coming down without answering the why question. So I want to take a little bit of a deep dive, both locally and nationally now, and show you what's going on. And again, I'd like to start with my 7-day moving average, which shows you number of new listings coming on board, which is the top line, the number of homes going under contract, which is the bottom line, which is kind of flatlined. I go over to last year, and you can see right about here that it's pretty much mirroring the same seasonal pattern. And we did see a little bit of increase in new listings coming on board, and it's not much. It's actually back on market. People that took their homes off the market for the summer, and now kids are back in school. Like, okay, well, let's put it back on now. We're home, no longer traveling. So that's what's going on in the Arizona market. Now, I track the percentage of homes under contract versus new listing. We're down to 74%. We were running 85 to 90%. It's not significant, but it is trending down. If the gap grows further, if it gets to 65%, you can expect to see some downward pressure on list pricing. However, there's going to have to be a catalyst. Again, why will new listings increase? And that's what I want to take a look at. So we're not seeing any downward pressure on prices. And when I say that, not every neighborhood. We are seeing the CMI kind of make some adjustments in the outlying areas, Queen Creek, Surprise, Maricopa, Buckeye, not Surprise, but Maricopa, Buckeye, Queen Creek. Those are the ones with most of the new construction. Now, if we look nationally here, the Redfin CEO came out and said, we've reached a new peak of affordability. In other words, the opposite direction. We're less affordable now than we've ever been. Well, there's your first why. Why haven't prices crashed already if our affordability is that bad? And here he said, affordability is even lower than the housing crisis of 2008, but the market circumstances are much different. This is primarily a supply issue, not necessarily demand. Now, we've been screaming this from the rooftops for a long time now. It's all about supply, and you're probably getting tired of it, but that's what it is. And he said, typically in a market where interest rates rise as fast as they have under the Federal Reserve's ongoing rate hike campaign that currently has the average for a 30-year mortgage rate around 7.1, housing prices would be expected to pull back. Makes sense. This time around, it's been the exact opposite. And it's not because of lack of demand, but because of abundant demand. It's because of lack of supply. He said, so basically what it means for consumers is we don't think the housing market's going to have a substantial drought anytime soon. So what they're saying is more of the same, folks. There isn't enough supply hitting the market. Now, why is that? Well, let's take a look at mortgage holder equity here for a moment from our analysts out here at Black Knight. Let me put this back up here. And I'm going to close this other out because there's a video playing in the background. So, boom, it's gone. Sorry, Neil, had to kick you off. What we have here is home prices rose 0.67 month over month in June, while after slowing for 14 consecutive months, the annual growth rate rose 0.08 in June. Now, this is nationally. We actually went down a little bit. But despite the overall outstanding mortgage debt surpassing 13 trillion for the first time ever, home price growth has also pushed homeowner equity levels back to within 3%, the 2022 peak. Here's the kicker. Total mortgage holder equity topped 16 trillion again in June, with tappable equity, the amount that can be accessed while retaining a 20% equity stake, climbed to 10.5 trillion. That's how much money is available if you wanted to tap it. And it's within 4% of the 2022 peaks. While the number of underwater homeowners is nearly up 70% from last year, it remains 52% below 2019 levels, with just 344,000, not even 1% of mortgage holders nationally currently owing more than what their home's worth. Now, that's a lot of numbers to throw at you right there, but basically what they're saying is there's a lot of equity out there. And if you look at the majority of homeowners that are out there that are underwater, it's not even 10%. It's not even 5%. It's not even 1%. It's 344,000. People are not going to hand their homes back to the bank because they're upside down, because there's only just a handful of them that are upside down. So they might. The other thing to consider too is, why would somebody hand their house back to the bank? Well, here's when you're going to hand yourself back to the bank: when you get in a financial pinch. So let's say there's a big recession coming and there are people saying it's going to happen. It's not going to happen. I don't know. You can drive yourself crazy trying to figure that stuff out. But usually you stop paying your credit cards first. Then you might let them take your car. Your house is the last thing you're going to give up because you need shelter. Because if you're going to move, you're going to have a hard time moving into a rental because now you don't have a job. So you're going to have to move in with a family member or have family members or friends move in with you to help you with a payment. But the house is the last thing you're going to give up. So if there's only a fraction of people that are upside down, and statistically, it's still way below normal, that doesn't show me that there's a wave of homes that are about to hit the market as foreclosures. We have a comment here. What about homes in the 2.5 to 3.5 million range? I'll take a look at that and see what I can glean. Right now, it's slow. That price range slows down in the summertime. They don't market their homes because they don't want to move in June and July like us paupers here. Sean says, what do you think about September will look like, thinking of listing in Mesa? It's still going to be slow, Sean. Slow in transactions. But again, it looks like that ratio of September or from listings under contract to available new listings is still going to be in the mid 70s. So I don't see it dropping to 60, because here's our trend right now showing on active listings. We're flatlining. So we're just staying flat, 10,150. You can see by the ticker this morning, I think we're at 11,000 something on my active chart for this morning. So let's see, I'm waiting for it to roll up here. 11,000 has been where it's hanging. It's staying right there. Again, I don't see that moving up. And that's the number you're going to want to watch, Sean. If that moves up, then off you go. Now, if you get in a situation to where in this market, we're way down in transaction volume. So lenders, real estate agents, they're starving. There's not a whole lot going on out there. Some are doing really well. But there's not enough business out there for the number of people that work in this industry. So when you hear numbers like down 40%, that's transactions. We also know that if interest rates go down, that we'll see some uptick in activity. 7% is where we're at. I could make the argument that rates are going to go higher. I can also make the argument rates go lower. Mortgage Bankers Association is saying 5.9% by the end of the year. They've been wrong before, and I think they're going to be wrong again, because you can imagine it's going to have to take something really radical here in August to make rates go from 7.03 to 5.9 by December. I don't see it. I don't see it happening. I'm less and less inclined to believe that that number is going to show up. Now, if that starts to show up, you're going to start seeing an improvement in September. Now, we've got a couple key numbers coming out this week. You might want to watch, Sean, and that is CPI is coming out again. And then what's the other ones? CPI, and there's so many acronyms in there. Anyway, there's two numbers coming out Thursday and Friday that will kind of give us an indication of what we think the Feds are going to do again in September. But we don't need to wait for the Feds for rates to come down. And I'll show you why in a moment. The other thing looking at here is months of supply. So we already look at the number. We say we have 11,000 homes on the market. Big deal. What does that mean? Well, how much are they selling? And that tells us how much supply is out there. That 11,000 at the current rate of people buying, it'll take 1.6 months to get rid of our current inventory. Normal's 4 to 6 months. So it's slow, it's dead. There's not many listings, but statistically, they're moving at a fairly decent clip, 1.6 months of supply. Now, this one's unusual, and home price growth by months into the decade. This is from my friends at BAM here with their hot sheet. And I always caution you, beware of people saying, well, this time it's different, because in economics, it's really, oh, thank you, Betta, CPI and PPI. I've got such a smart audience on here. And I could probably stand to use another cup of coffee, but this time it's different. No, it's not always different. There are certain economic indicators that come out there. They're going to mean something. Our level of debt is a problem. That is going to put upward pressure on rates, regardless of CPI, I think, in my humble opinion. Because even now, the Treasury is issuing all of these Treasury bonds, and in order to solicit demand, they're going to require a better return. So it's just like you selling your house. Okay, so you're going to have to price it accordingly. If there's a lot of demand, you'll get more for your house. And so if there isn't any demand, you're going to have to offer something like a lower price. Treasury bills are exactly the opposite. The Treasury is saying, look, we need to finance this debt. Please buy some of these bills from us. And they go, well, you're only offering 5%. I'll be interested if you offer 5.5. So that is, in a nutshell, what's about to happen. And that puts pressure on interest rates for you and me. This is seasonally adjusted Case-Shiller National Price Index. Let me explain it to you. This is over 10-year periods. In the 90s, here's the blue line, going up to 30%. Here's 2010s going up to 40%. Here is the 2000s, which includes our disaster here in 2008, coming down. But again, it ended up trending on the upside. I'm trying to get my handy dandy little red pen where it only works when it wants to. And here we are today. This is nationally Case-Shiller. You can see that we took that downturn in January. Case-Shiller runs behind about 90 days. This has since turned around, but it shows you that over a decade that home prices continue to go up. So it's very interesting. Now, I want to look at mortgage rates. Go to this link here, which is Mortgage News Dailies. I think I put the link in the description. If I did, I put it in the description below. This is the one you want to watch. If the number's red, then that means interest rates are going down. If the number's green, it means interest rates are going up. This is the chart that Pat shares with you every Friday and every Thursday, and it shows you what's happening today. So right now, rates are trending down, trending up because the number's red. So this gives you real-time data on what's happening with mortgage-backed securities, not 10-year treasuries, although the two are pretty close. And here we are here with 10-year treasuries over the since 1985. You can see the trend here. Now, something that I hear a lot, which I don't like, and that is, well, when I bought a house, interest rates were 12%. I just read you some numbers that said that we are at an affordability peak. Doesn't matter what the rate is. What you want to concentrate on is affordability. And right now, the affordability's as bad as it's ever been. But again, well, why haven't prices crashed? If that's the case, how come they haven't come down yet? You would think that if we reached this peak in lack of affordability, that something would crack and something would break. Because you get up there and it's no longer affordable, people are no longer buying, prices are going to come down. Well, people are no longer buying. We're down to about 2,700 contracts every 7 days. Good morning, Jackie. And it's still enough to absorb the inventory that's out there because people are not selling. They're not moving. Until something changes that, I don't see that scenario mixing up much, because there's really no incentive for anybody to sell their house. And a number of people that have homes under 4% are just fine. People that told you it was going to crash in 2021 really caused you a great disservice, because there was a lot of money to be made. The money was free. It was obvious that we were going to have growth in assets and commodities when rates are down to near zero. And people were kind of ignoring this. Now, in 2021, I called it the silly season. And my advice to first-time home buyers was, you might want to sit on your hands for a while, only because we reached a point where people were making bad decisions. Now, they were bidding up on the price. I get it. You had competition. But the reason I said sit on your hands was, a lot of you are waiving your inspections. That can cost you a lot of money. You might overbid by $50,000. Okay, you can roll that into cheap financing. But when you get that $35,000 roof repair bill, you're not rolling that into low financing, perhaps. There's a lot of things that people were walking away from. They were shortening the inspection period. They were waiving the appraisal. In other words, I'm going to pay $500,000 for this house, but if it only appraises at $450,000, I'll make up the difference. So it was kind of like a trifecta of problems that you were creating for yourself. So I was advising, don't do that. I mean, go ahead and put your bid in on the house and hopefully you can get it, but don't do those silly things like waiving an inspection. That's going to cost you some money. And in a lot of cases, it did. People moved in and said, oh my God, look what broke. Inspections are important. Don't walk away from those. You've seen me on with Dylan. I'm trying to hook up with Dylan this week and do another one. He's got he's with Pro Inspect, has a very active Instagram page. Man, some of the things that he puts up there just makes your hair hurt. But it's funny stuff. So I'm hoping to have a good, funny video with Dylan coming up pretty soon. Funny, yet serious. Now, the other thing is, why haven't high interest rates killed the housing market? Well, they have. They've really killed the activity. But there's still enough people out there where interest rates are not really affecting them that much. They still want the house. There are some bidding wars in certain neighborhoods, but here in Arizona, it's not across the board. In fact, I think houses over list price, last time I looked it up, see if I can find it here. Listings, let's see. Whenever I do this, closings over list price, there we go. I got quicker at it today. Let's see. It's showing us going up a little bit, 24%, which is a bit surprising until you look at the segment of where this is happening, which is almost a non-existent price point now, 300 to 400,000. And 29.1% of those are going over the list price, but it's down to about $5,000. So it's not huge. So the averages, they're going about 5,000. In most cases, they're either using that for a rate buy down or just help with closing costs. So while we do see closing over list prices go up, it's nowhere near what it was back in the silly season, where 60% of the homes were going over list. And this is when the average at that point, the average was $15,000. So we're getting some relief there. In the 500 to 600,000 range, there were only 664 homes, only 19% going over list price. Jackie here says, we just had one at a 520 price point, sold for 530. Crazy, it appraised. I was actually surprised. Yeah, especially because we kind of had some chatter out there that appraisals have been a problem lately. Again, All depends on the neighborhood. Yams said, with all the vacant single multifamily homes for rent throughout the valley, how do investors afford to keep paying the mortgages? Nobody's in it for months. All depends on the vacancy rate. The overall vacancy rate is still below 6%. I think we're at 4.5. So until that really explodes, they can afford it. All they have to do is just lower the rent. Now, if they bought in 2022 and they overpaid, yeah, that we have a problem. But we're seeing that a lot of the excess that we're seeing in rentals, and I was having this conversation with my middle son yesterday, is in apartments, particularly in Tempe and Gilbert. Huge explosion of apartments, and that's starting to show up in lower rent. And my son said he's seeing it about at 11%. So Sean here says, does that mean if my house is being listed between 400,000, I can get aggressive on pricing? Currently, yes. Be careful how aggressive you get, but also keep in mind that if you aren't aggressive on pricing, the buyers will be aggressive for you, Sean. So the last thing you want to do is overshoot. If you're looking at a market between 300 and 400,000 and you price it at 390, like Jackie just showed, they'll pull you up. If you price it at 425, they may ignore you, and that's going to cost you time in the market, and time is never your friend. So the strategy of just staying close is what I would advise. In fact, Jackie just came in and said, better to price at market and let the market come to you. Absolutely. Everybody likes to say, let's test it. Well, that's always a failed test. So the price that you ask for is you're going to get the price you're going to get. Just depends on how long it's going to take to get there, Sean. So if you have a home and you're looking at it and you're waiting and you're thinking what your price is going to be, you still have to look at supply and demand. So just don't price it at $399, $999, $999. That drives me nuts. I had a client that was going to list his home and he wanted to about 1.3 million. I said, please don't ask me to price it at 1.29999. And he did. It just $1. And here's why at 400,000, you don't want to go 399, 999. For $1, the person that's looking at between 400,000 and 450,000 doesn't see your home. It doesn't show up in a search because of $1. People search in $25,000 and $50,000 increments. So people looking between $350,000 and $400,000 will see your home at $399, $999. The person that's going from $400,000 to $450,000, you won't show up. If you leave it at $400,000, now you show up in two different price categories: $350,000 to $400,000, $400,000 to $450,000. So don't screw yourself over $1. So running at altitude here. Good morning. Thanks for joining me. Arizona real estate. Did the property have multiple offers? I'm going to guess and say yes, it probably did. Jackie's been running into that a lot lately. So Sean, I hope that answers your question. September, I don't expect it to be any different than what we're seeing now in August. I don't see anything coming along that says we're going to have an interest rate boost. You'll get a clearer indication of that when the CPI number comes out, though. Yes, just two, though. We had lots of interest, too. We just let the agents know that. So you just tell the agent, we got a lot of people that are interested, but we only have 2 offers that have come in so far. So they'll bid you up. Now, CPI, in my opinion, is probably going to show an improvement right now, but I'm not very optimistic over the next 6 months in CPI. And that is because all the money from the Treasury hitting our economy right now, that $1.3 trillion of what I call the Inflation Production Act, is starting to hit the economy. And as that starts rolling in with infrastructure projects and the like, I think a few months from now, we're going to start seeing more pressure again on prices and services. Right now, employment is starting to go down, which puzzles me because everywhere I go, I see a help wanted sign. I don't think our unemployment is going to spike to the level that's going to affect inflation. So we're not going to get anywhere near that 2% target, I don't think, through 2024. And that's about as much guessing as I'm going to do. Good morning. It is good to see everybody. And so Ask the question why. When somebody says it's going to crash, I want you to say, well, why? I watched one this weekend, like I said, and is one of my least favorite people in California going on and on about how prices have gone up and this and that. And I had to turn it off. It's like, are you ever going to share any numbers? I mean, okay, I get it. If inventory goes up, we have a problem. Tell me what's going to cause inventory to go. It's not always high unemployment. And if it is high unemployment, tell me what's going to cause the high unemployment. I mean, I think that's kind of an easy statement. It goes, we're going to have a really bad recession. Well, why? And inventory is going to go up. Why? And there's going to be a lot of employment. Why? Could all this happen? Absolutely. We could have a really bad recession. That's always hanging out there. It looks more likely now than maybe it did a couple of years ago, but people have been screaming recession for the past 2 years. Look at the inverted yield curve. Here it comes. We're well on our way. The crash is coming. I'm not seeing it yet. Maybe this time is different. Nope, it's never different. It's all, you have to watch the numbers and you have to be careful. But I just showed you that chart over the 10 years. Who gives a rip? Don't look at your house like your 401k. It seems like there's tremendous amount of inventory in the 2.5 to 4 million range. Not much selling, but prices are really high. Let me look that number up while I have you on here. I see more construction competition as they have more incentives than resale. New construction is doing well, and that's exactly they're able to finance it with mortgage buy downs. I'm going to pull this up here in the 2.5 range and see what we're doing as far as inventory. And I'm going to go 2.5 to 3 million right here, and it's coming up. It's down to 2022 and 20. Let's see, the red one's 2022, the brown one's 2020. So we're right there from 2020 and 2022. We're not down to 2021 levels. So inventory is down 287, and that's why prices have not gone down. This will start to climb up seasonally like it does every time as you get out of summer. So inventory will start to climb, but I think the sales will follow it, and they are followed more closely to the stock market than it really is to interest rates. So that market is doing well. I hope that answers your question. I do see more back on market price reductions on all familiar price to sell. So it has shifted from over asking price. Could it be a sign of a worsening market? Yes and no. I think back on the market that I'm seeing is about 100 to 125 homes is seasonal. Everybody went back to school. Let's put the house back on. I think price to sell is people that shot too high. In other words, if you look at their original pricing, you can probably look at it and going, well, they thought they could get this, but they can't. So you want to look at the average price per square foot on actual sales and compare it versus list price, because there's a thing called wish pricing. And that is the people, and you saw it in 2022, that when interest rates came up, we flooded the market with homes and people put up their Zestimate. Oh, my house is worth 700,000 according to Zillow. So I want to market for 725. I want to grab this equity before things turn. Well, guess what? They found out that they weren't getting any offers. So they pulled them off the market. The number of expireds we had was astronomical. So they threw it out there thinking they were going to get that. We have some of that going on still in certain neighborhoods. I think I can get this, and then I have to do price to sell. You'll see in Facebook forums where a lot of real estate agents are saying, my client still thinks that they can get X amount of dollars, and I'm showing them the data, and they're like, well, let's try this. And that's, I don't like trying that. Like I said to Sean earlier, if you price too low, relax. Your buyers are going to pull you up. Airbnb revenue has fallen off a cliff. Eventually, those investors will be forced to sell. They may be, but their revenue has fallen according to their last quarter results, but vacancies really haven't. I think it's an adjustment of saturation. There's a lot of them, and it's fallen from peak levels. Now, Airbnb makes their money. Doesn't mean that the people that are actually renting out their places aren't making money. It just means Airbnb's business model has some hiccups on it. And it could be eventually investors going. Remember, if all the Airbnbs in our market list tomorrow, still won't be enough inventory. That won't even put us up above 24,000 units, which is normal around our markets, about 27,000 units. In 2008, we had 58,000 homes on the market and demand had dropped. Could you imagine what would happen to real estate prices if we had 58,000 homes on the market and only 2,700 homes going under contract every 7 days? What would happen to pricing? You don't have to imagine. You can go back to 2008 and you can see it in real time. It was right there. So if all these Airbnbs say, I'm dumping them, they'll get gobbled up as soon as they hit the market because they're a very high quality product. They're in great shape. They're not a fixer upper. They're really in good shape. Some of them come with furniture. So bring them. We as agents, we would love to see these Airbnbs start hitting the market. Trust me, I have buyers. They want those. So I don't see a possibility of there being a dump that's going to affect the market. There will be some investors that have to get out because they bought in a little too high. They got a little aggressive. They're finding out that's not happening, particularly in Sedona, which is oversaturated. Now, where I'm at, they're trying to regulate the living daylights out of them up here with no success, and they're just booked solid. My brother's got a couple in his this weekend from Germany, and they're filling up. Every national park I've gone to here, every place I've tried to go, I can't get into it unless I go at 7 in the morning. It's just too crowded. There is a possibility of a soft landing provided the Fed tightness doesn't affect the previous home buying spree. If we had a large percentage of fear of missing out buyers, then we'll see a large blip in sales. We get down to 5.5, the doors are going to open. That's not a guess. We've already seen that. The last time rates went up, then they came down to 5.5. We saw an immediate jump in mortgage applications. So we know that. Now, what's it going to take to get 5.5? Time. That could happen. So that's the numbers we need to watch. But getting back to inventory, yes, people feel that Airbnbs are going to flood the market. They feel like there's going to be a wave of foreclosures that are going to happen. I don't see any of that in the numbers that I'm looking at right now. So stay tuned. I plan to bring you more of this. I might even be on tomorrow for giggles. So have a great day. Take on the rest of the week. Take care.